The Reserve Bank board meetings minutes for July paint a gloomy picture of the economy. It's a different picture than Governor Philip Lowe seems to paint in public. The Reserve Bank's left the door open for more interest rate cuts due to their concern about the state of the jobs market and the lack of wages growth. So what does that mean for our economy? What does it mean for our property markets? And I guess you're wondering, what does it mean for your pay packet? So to find out, let's talk to Australia's leading economist, Dr. Andrew Wilson, Chief Economist for My Housing Market. Welcome, Andrew.
Thank you, Michael. Yes, it was certainly a very interesting read. Certainly, it tends to paint a different picture from that which has been publicly pronounced, particularly as we saw last week. As you'll recall, Michael, there was a bit of what I call a delusional gab fest between the Treasurer and the RBA Governor regarding the prospects for the economy. I guess they've got to be positive and optimistic. They don't want to create negativity and sort of refuel falling confidence. But certainly there's no doubt that those minutes do signal another cut, maybe cuts, to interest rates in the future, in the near future. And I'm a little concerned about that, to be quite honest.
Well, the Reserve Bank board members agreed before the July meeting, when they lowered the interest rates to 1%, they agreed to accelerate job growth. They recognised that we need to stimulate jobs. But the minutes of this last meeting, only a couple of weeks after that interest rate drop, they seem to suggest that the economy is a bit worse than we're expecting. And as you say, the market's now pricing in a 78% chance of another 0.25% cut later this year. So what's going on with our economy, Andrew?
Well, we really haven't made any progress in the issues that have been concerning central bank governors right around the world. Australia's been stuck in that same position of low interest rates, relatively low interest rates, and the failure to reignite inflation, particularly as a product of the failure to grow incomes. And of course, the theorists are now throwing out the rule book. It's interesting, Michael, and I don't want to get too deep into economic theory here, but certainly we're seeing the end of what has been a fundamental cornerstone for monetary policy, and that's something called the Phillips Curve. And the Phillips Curve was a product of research that reflected the relationship on interest rates and inflation. And basically it was that the lower you got with interest rates, the more you'll fuel employment growth, incomes growth, which would then work its way into inflation. Now, there was this process where you would find the actual point of the lower interest rate market where inflation started to rise. And that was called the non-accelerating inflation rate. But of course, this has all not worked this time. The rule book has had to be thrown out. And what concerns me to some degree is that maybe on a wing and a prayer, the Reserve Bank are clinging to the hope that perhaps the Phillips Curve will re-establish itself as a cornerstone for monetary policy. I don't think it will. And a lot of theorists now around the world, macroeconomic theorists, are really recognising that that nexus between lower interest rates and higher inflation is broken, and we've got to think of other mechanisms to grow the economy.
Well, the Reserve Bank seems to have hammered an ambitious stake in the ground. They're indicating they want to drop unemployment to 4.5%, and arguing that at that rate, employment's going to be reasonable. They're going to consider it full employment. I remember when full employment was considered a much higher level than that. They think the excess capacity in the labour market's going to be soaked up, wages are going to start rising, and their argument is that that's going to drive inflation to their target range. But I don't know, to me, it seems like quite a challenge. The last time unemployment's been that low was over a decade ago, and inflation really hasn't been in that 2 to 3% range other than spasmodically for quite some time. Is it going to work?
I don't think it will work, Michael, and I think this is recognition now around the world to some degree. And I think the problem the Reserve Bank has is that it really sat on its hands for a number of years and didn't act through what I believe, and I think most recognise, was almost an obsession with Sydney house prices, that they had some concern about an over-controlled housing market, bubble bursting as the theory goes. So they kept rates too high for too long. And now, of course, they've done that 180-degree turn and trying now to re-stimulate the economy. And really nothing's changed in the economy, Michael, over the last 2 or 3 years. I mean, we've known that inflation was stuck low. We've known that incomes growth was stuck low. And yet we've continued to hope and pray that things would change. Well, they haven't changed. And now we're back to, I guess, vaudeville and cutting interest rates in the hope that it will refuel the jobs market. I don't think it will. And I think even the minutes of the Reserve Bank meeting, Michael, have given us an insight to exactly what is happening in the labour market, which should give us some concern, and that's about the participation rate. And I just don't know where the jobs are going to come from to push our unemployment rate down by a full 1%. Those previous low unemployment rates you mentioned, Michael, were a product of a once-in-a-generation mining boom, which created the demand for infrastructure development, which was very labour-intensive. All the labour-intensive industries, all the labour-intensive sub-markets that we need to be ticking over are actually going backwards. And of course, that's residential construction, commercial construction, and the retail sector. And of course, agriculture is suffering from the drought. So I just don't know where these jobs are coming from. And as I said, I think that if we look close at those participation rate numbers, that's actually of more concern to me and what it reflects of the particular underlying nature of the economy.
So participation rates have increased considerably.
Yes.
And that means that even though more people are in jobs, the unemployment rate isn't going down. Is that what you're suggesting?
Well, that's right, Michael, but we've got to understand, why is the participation rate increasing? And I think this is particularly in the over 65s, which are at record participation rate levels. I think what we're seeing is the increase in participation rate is forcing people back into the workforce who can't support themselves, particularly on fixed incomes. And I think that this shows that it's a pincer movement of pushing people back into the workforce, because the workforce, the labour market, is not producing the higher incomes through the ancillary sub-markets that reflect fixed incomes, residential investment, the stock market. And that means people are pushed back into work because they can't live. We've seen the savings ratio is at record low levels, so people are pushing into their savings just to survive because incomes growth is so low. And now we're seeing people being forced back into the workforce. Now, that's not a scenario for me that should give you optimism about the job capacity or the capacity to create the jobs for these people who are getting increasingly desperate to find income.
Well, these concerning things you're bringing up seems to contradict the positive spin that the Reserve Bank governor put out not that long ago when he met Treasurer Josh Frydenberg. And in his words, he said, "I agree 100% with you." He said, the economy is growing and the fundamentals are strong. But the minutes don't really suggest that, do they?
Firstly, we can suggest, well, where are the jobs going to come from with these lower interest rates? It will take some time to refuel the housing market and create more demand for construction, residential construction, particularly apartments, which are so labour intensive and which have been a key driver of our economy in recent years. Now, that's going to take some time, Michael. And we're also seeing commercial construction or planned commercial construction starting to decline as well, which is of a concern. So those lower interest rates are certainly going to take some time to work their way into increased residential construction. And I'm not sure that, given the nature of consumer sentiment, whether the lower interest rates will also increase retail spending. I don't think that the tax cuts, which of course are a positive, are going to be translated into increased spending in the same way that when we got the boost during the post-GFC period, that worked its way into increased consumption. I think we're saving as desperately as we can at the moment, Michael, and it's really been a reflection of all the doom and gloom and negativity that's infected our commentary and the issues over inflated house prices. People are thinking, well, I'm just going to pay down my mortgage. I'm not going to spend this money. Now, having said all that, I think the other thing that has to be mentioned, Michael, is the fact that the international circumstances are working clearly against the Reserve Bank now. Now, what we're going to see likely, almost 100% likely, I believe, at the end of this month, is a cut in official interest rates. The US is becoming concerned that its inflation rate is not picking up, its incomes growth is not where it should be, and they're going to cut rates. Now, of course, they've had a considerable period of pushing rates up, so they have a little bit of ammunition in the, I guess, to be able to stimulate the economy. But what they're worried about is that the US dollar is now too high. They want to see that lower. Now, of course, what the Reserve Bank governor wants to see is a lower Australian dollar. But of course, if the US dollar is weakening, then those efforts to push our dollar down are going to be neutralised. And of course, what we're also seeing is now with the prospect of a new Prime Minister in the UK, we're looking more likely to have a hard Brexit, which will mean that there's going to be some real issues in terms of the perceptions of the UK currency. Now, we've already seen a weakening of sterling. The UK currency is now gone backwards. We're also seeing the Eurozone stating, because its interest rates are still at zero, that it's going to start, the central banks of the Eurozone are going to start buying government bonds again. So what I'm saying is this will only put downward pressure on currencies in the global market, which will unfortunately neutralise our lower interest rates. So really, we should have been lowering interest rates when the rest of the world was raising rates, or certainly were putting a floor under lower rates, not now when everybody else is going down, because it won't create the lower dollar that we need as part of our job creation environment to improve our export sector.
Looking at the property market, clearly the lower rates and more jobs are going to be positive for our property markets. And unfortunately, some commentators are suggesting we're on the cusp of another boom with surging house prices. I'm sure you've read that as well, but I can't see another property boom ahead.
No.
And if there is one, I can see that's actually going to create quite some policy dilemma for the Reserve Bank.
Well, there won't be a property boom, Michael. History will always tell us that that's a very strong relationship between lower interest rates and higher house prices and more demand. Now, we've already seen that. There's no doubt that house prices are starting to stabilise in Sydney and Melbourne, the recent declines. We're now clearly reaching for the bottom of the market. Clearance rates are remarkably in Sydney pushing up towards 80%. They're around 70% in Melbourne. We know that that will mean higher prices. Now, also listing numbers are low, so we've got to mention that. But that sellers will come back into the market, but at lower levels. But the reason we won't have a boom, Michael, is we still have restricted lending to investors. And investors are the key ingredient for any house price boom, as we saw in Sydney and as we saw in Melbourne. It's really cloud cuckoo land, Michael, to be talking of any price boom in our housing markets, because that missing ingredient, that key ingredient, which are investors, are still a long way off to get back to anywhere near the levels that we had during the strong prices growth of 3 or 4 years ago.
I agree with you. Interest rates are lower and serviceability criteria have become a bit easier. So banks are lending a bit more, but the missing ingredients is still the ability to get the loans because of the harder requirements from the banks. And we don't want a boom. So I'm comfortable that the market's moving ahead.
Yes.
It's had its breather. It's dropped in some areas. In other areas, parts of Australia, it's stabilised. But in my mind, this is a very good counter-cyclical opportunity to get in when the downside is minimal and the upside is more positive now than it's been for a number of years. But I think if people are doing it and they're going to expect 20% property price increases, digit growth, they're going to be sorely disappointed.
Look, I agree, Michael. And I think next year, just hazarding an educated estimate of price growth, I think all things being equal, and I suppose that's the get out of jail card, I think that we're looking for perhaps 3 to 5% growth in that Sydney and Melbourne market, which is quite a reasonable result over the year. Now, that depends, of course, on the factors such as the economy at least remaining reasonable through that period, and of course migration remaining reasonably strong, as it's likely to do, because the government can't turn the migrant tap off, because that's such an important part of economic growth. But of course, that's well short 3 to 5% of the sort of numbers that are being bandied around. Again, it's a cheap headline. We shouldn't buy into this, but unfortunately, these headlines will always be with us until we do have it.
I click on them, Andrew, because I want to hear what others are saying.
Well, that's true, Michael, but it is, as we described, a little unkindly perhaps, as sucker bait, but it does work, that bait. I noticed there was another one that I saw last week, somebody coming out from the US another fortune teller who's predicting, his headline was prices to fall, I think 10 to 15%. That is fall 10 to 15% next year. Of course, it got a few headlines around the traps, perhaps not as many as it would have previously, but that was based on some fanciful analysis that this was all about fewer Chinese investors in the Australian market. And of course, the relationship between higher house prices and Chinese investors has been really debunked over previous years because it was only a very, very small proportion of the market that was engaged in from Chinese overseas buyers.
Well, rather than looking for the next hotspot and seeing where that growth period is going to be, and then as they're already bringing out now the new hotspots, I'd be suggesting that there isn't one Melbourne property market, there isn't one Sydney property market, or Brisbane market. So there are markets within markets, geographically, price point, type of dwelling, and there are definitely always going to be areas that outperform, and there are areas that are going to lag, and that's what we've always suggested. Look for those areas where there's multiple pillars supporting the local economy, local jobs, and look for areas where there's good wages growth and people have got steady jobs. That's going to underpin the home buyers there. It's going to hold the property market there. Don't chase investor type properties.
Yeah, that's right, Michael. And I think in a way, a flatter cycle means the end of those sort of hysterical hotspot analysis. I also want to suggest that even though as a macroeconomist, I have concerns about the nature of monetary policy, what it's expected to achieve, and I don't think it will, and its impact on the property market. What we've seen is the clearest relationship between economic policies and the housing market are interest rates. Now, we've really actually seen when we have periods of higher unemployment, it doesn't have the same impact on the property market as changes in monetary policy does, that is interest rates up or down. So I think that even if we have a period of higher unemployment, which of course is against all what the Reserve Bank's trying to do, I don't think that will have a material effect on our housing markets. I think it's all about interest rates in terms of the housing markets, and more falls in interest rate are obviously a positive thing for the housing market and for those in terms of borrowing capacity, and for those that are paying off a mortgage, puts more money in their pockets. But look, having said all that, Michael, we are in this conundrum that advanced global economies are in, and it means we'll have to switch from monetary policy, that is interest rates, to fiscal policy. And there are two ways that that's addressed by governments, that is by trying to stimulate the economy with government spending. That's through either direct spending, through such things as infrastructure projects, or through tax cuts. At least the positives for Australia are the current account position is very positive and strong at the moment. Our balance of trade and our terms of trade is very strong. And of course, our budget is in a positive territory. So we still have the capacity, if we move, which I think we will have to do, to fiscal policy, to be able to stimulate the economy where others can't. So let's not be too pessimistic about Australia's prospects.
Well, the Reserve Bank governor has similarly said it can't only be in their hands. The government don't have to step in, and it looks like they're listening, so that's great. So some green shoots ahead, some headwinds holding us back. But thanks again, because a great chat today.
Good on you, Michael. Thank you.